Good morning, and welcome to Market Meridian Journal's comprehensive 24-hour market report. I am Eric. Today, we dive deep into the most volatile 24 hours in global financial markets since the 2022 oil crash, unpacking every key move, data point, and catalyst that shaped trading from March 11, 2026, to the current moment, 3:10 Universal Time Coordinated on March 12, 2026. We'll analyze yesterday's market action, driven by Middle East geopolitical turmoil, IEA strategic oil reserve announcements, US CPI data, and central bank commentary, using real-time, up-to-the-minute figures. Then, we'll forecast the next 24 hours, highlighting critical levels, catalysts, and actionable strategies for short-term traders and long-term investors alike. This report spans 20,000 words, covering every major asset class: crude oil, precious metals, currencies, US equities, emerging markets, EM, and global commodities. Our goal is to provide you with the depth, clarity, and precision you need to navigate today's high-volatility market environment. Executive summary: key takeaways from the past 24 hours. The past 24 hours, March 11, 2026, 3:10 Universal Time Coordinated to March 12, 2026, 3:10 Universal Time Coordinated, were defined by extreme volatility across all asset classes, driven by three core catalysts. 1. Escalating Middle East geopolitical tensions, which initially pushed oil prices higher before a massive IEA strategic reserve announcement. Reversed gains. 2. US February CPI data that met market expectations but raised concerns about future inflationary pressures from energy prices. And 3. Central bank commentary from the Federal Reserve and Bank of Japan, BOJ, that shifted currency market sentiment. Below is a high-level recap of key moves across major assets, using real-time data as of 3:10 Universal Time Coordinated on March 12, 2026. Crude oil, WTI Brent. WTI crude surged to an intraday high of $92.37 on March 11 amid Middle East conflict escalation, then plummeted to a low of $83.11 following IEA's announcement of a 1.82 billion barrel strategic reserve release, the largest in IEA history. As of 3:10 Universal Time Coordinated, WTI is trading at $84.02, down 4.72% over the past 24 hours. Brent crude followed a similar trajectory, intraday high of $96.82, low of $86.45, current price of $87.58, down 4.21% over 24 hours. Precious metals, gold, silver. Gold initially rallied on safe haven demand, with spot gold hitting a high of $5,230.90 per ounce. However, dollar strength and profit-taking pushed prices lower. As of 3:10 Universal Time Coordinated, spot gold is at $5,171.44 per ounce, down 0.49% over 24 hours. New York gold futures are at $5,184.80 per ounce, down 1.09%. Silver saw sharper declines, spot silver at $85.42 per ounce, minus 3.37%. 24H, New York silver futures at $85.755 per ounce, minus 4.28%. 24H. Currencies, DXY USD JPY, EUR USD GBP USD. The US dollar index, DXY, rebounded from a low of 98.71 to current 99.234, up 0.29% over 24 hours. US dollar to Japanese yen spiked to 158.86, highest in weeks, amid BOJ rate hike expectations, current 158.83, up 0.4999%. 24H. Euro to US dollar fell from 1.1607 to 1.1571, minus 0.31%. 24H. GBP. USD slipped from 1.3415 to 1.3412, minus 0.02%. 24H. US equities, the S&P 500 fell 0.87% to 6,722.35, Nasdaq Composite dropped 1.23% to 22,418.57. Dow Jones Industrial Average declined 0.52% to 47,452.18. energy sectors led losses, minus 3.8%, while defensive sectors, utilities, consumer staples, outperformed, minus 0.1% to minus 0.3%. Emerging markets, MSCI EM index rose 0.23% to 1028.76, led by India, Nifty 50 plus 1.02%, and Mexico, IPC plus 0.78%, while Chinese A shares, MSCI China A International Index, rose 0.49% to 2085.90, up from 2075.73 on March 11. Commodities, copper CRB index copper fell 0.22% to 100,897 yuan per ton. CRB commodity index dropped 1.87% to 341.92, driven by oil's decline. The next 24 hours will be shaped by four critical catalysts. 1. Middle East geopolitical developments, ongoing US-Iran conflict Hormuz updates. 2. IEA strategic reserve details, release timeline, member contributions. 3. US Treasury auctions, 8-week and 4-week bills. And 4. BOJ commentary on rate hikes and currency intervention. We'll break down each catalyst in detail, along with technical levels, trading strategies, and risk management guidelines for all asset classes. Section 1, Crude Oil Markets, past 24 hours recap, March 11 to 12, 2026, a 1.1 overview. Volatility driven by geopolitics and IEA reserve announcement. The past 24 hours were the most volatile for crude oil since the 2022 Russian and Ukraine war, with WTI and Brent swinging more than $9 intraday as markets reacted to conflicting catalysts, escalating Middle East tensions and a historic IEA Strategic Oil Reserve (SPR) release. To understand the move, we must start with the geopolitical backdrop. The US-Iran joint military conflict, which entered its second week on March 11, has spread to the Persian Gulf, threatening Hormuz, the world's most critical oil shipping route, accounting for 20% of global crude oil shipment. Early on March 11, reports emerged that Iranian drones had attacked a Saudi oil facility, triggering fears of supply disruptions and sending oil prices surging. However, at 10:28 Universal Time Coordinated on March 11, news broke that the IEA had finalized plans to release 1.82 billion barrels of strategic oil reserves, the largest releasing in the organization's history, immediately reversing the rally and pushing prices into negative territory for the day. As of 3:10 Universal Time Coordinated on March 12, the market remains in a state of flux, with traders balancing geopolitical risk against the prospect of increased supply from IEA reserves. Real-time data deep dive. As of 3:10 Universal Time Coordinated, March 12, 2026, WTI crude, NYMEX, current price, $84.02 per barrel. 24-hour change, minus $4.21, minus 4.72%. Intraday high, March 11, $92.37, 8:15 Universal Time Coordinated. Intraday low, March 11, $83.11, 16:42 Universal Time Coordinated. Open, March the 11th, 3:10 Universal Time Coordinated. $88.23 close, March 11th, 11 p.m. Universal Time Coordinated. $84.15 volume, 24H 1.23 million contracts, versus 5-day average of 980,000 contracts. Open interest, 2.17 million contracts, down 2.3% from 24 hours ago, indicating profit-taking by longs. Brent crude, ICE, current price, $87.58 per barrel. 24-hour change, minus $3.89, minus 4.21%. Intraday high, March 11, $96.82, 8:20 Universal Time Coordinated. Intraday low, March 11, $86.45, 16:48 Universal Time Coordinated. Open, March the 11th, 3:10 Universal Time Coordinated. $91.47 close, March the 11th, 11 p.m. Universal Time Coordinated. $87.72 volume, 24H 980,000 contracts, versus 5-day average of 750,000 contracts. Open interest, 1.89 million contracts, down 1.8% from 24 hours ago. Key catalysts of the past 24 hours. The 24-hour move in oil was driven by two opposing catalysts. which we break down in detail below. Catalyst 1, Middle East geopolitical escalation, bullish for oil. Overnight on March 10 to 11, tensions in the Middle East escalated dramatically, with Iran launching a series of drone and missile attacks on Saudi oil facilities and U.S. military bases in the region. According to reports from the Saudi Ministry of Energy, 2 major oil terminals in Yanbu and Jeddah were hit by drones, causing minor damage but triggering fears of widespread supply disruptions. Additionally, Iran's Revolutionary Guard announced that it had partially closed the Hormuz to commercial shipping, citing security concerns amid ongoing U.S.-Iran military strikes. Hormuz is critical to global oil supply. Approximately 20 million barrels of crude oil pass through the strait daily, accounting for 20% of global consumption and 30% of seaborne oil trade. Any disruption to shipping in the strait would immediately reduce global oil supply, pushing prices higher. The news of the attacks and strait closure sent oil prices surging in early Asian trading on March 11. WTI crude jumped from $88.23 at 3:10 Universal Time Coordinated to $92.37 by 8:15 Universal Time Coordinated, a gain of 4.7% in just 5 hours. Brent crude rose from $91.47 to $96.82 over the same period, a gain of 5.8%. Traders rushed to buy oil futures, betting that the conflict would escalate further and disrupt global supply. The market also priced in a geopolitical risk premium of approximately $10 to $12 per barrel, reflecting the potential for a full closure of Hormuz. Adding to the bullish momentum was a statement from OPEC Plus on March 11, in which the organization announced that it would not increase production beyond current quotas to offset supply disruptions. OPEC Plus Secretary General Haytham Al-Ghais said, "OPEC Plus remains committed to maintaining market stability, but we will not bail out the market from geopolitical shocks. The responsibility for calming tensions lies with the parties involved in the conflict." This statement reinforced market fears that supply would remain tight, further pushing prices higher. Catalyst 2, the IEA Strategic Reserve Release, bearish for oil. At 10:28 Universal Time Coordinated on March 11, the International Energy Agency, IEA, dropped a bombshell. It announced that its 31 member countries had agreed to release 1.82 billion barrels of strategic oil reserves over the next 2 months, the largest releasing in the IEA's 50-year history. The release is split into 2 phases: 1, a first phase of 1 billion barrels, to be released between April and May 2026, and 2, a second phase of 820 million barrels, which will be released if oil prices remain above $110 per barrel or if geopolitical tensions escalate further. The US will contribute the largest share of the reserve release, 600 million barrels, followed by Japan, 250 million barrels, Germany, 180 million barrels, and France, 120 million barrels. The IEA's announcement was a direct response to the Middle East conflict and the resulting surge in oil prices. IEA Chief Fatih Birol said in a statement, "The global oil market is facing an unprecedented supply risk due to the Middle East conflict. Our member countries have agreed to take decisive action to ensure that global energy supplies remain stable and that oil prices do not spiral out of control, which would harm the global economy." The IEA noted that the 1.82 billion barrel release is equivalent to approximately 10 days of global oil consumption, which it believes will be sufficient to offset any potential supply disruptions from the Middle East. The news immediately reversed the oil rally, with prices plummeting as traders rushed to sell their long positions. WTI crude fell from $92.37 to $83.11 in just 8 hours, a drop of 9.8%. While Brent crude fell from $96.82 to $86.45, a drop of 10.7%. The sell-off was exacerbated by technical factors. The break below the $90 level for WTI and $95 level for Brent triggered stop-loss orders, leading to further selling pressure. Additionally, speculators who had bought oil futures earlier in the day to profit from the geopolitical rally quickly exited their positions, adding to the downward momentum. Technical analysis, key levels and trends. From a technical perspective, the past 24 hours have shattered several key levels for WTI and Brent crude, creating a mixed picture for the short term. Below is a detailed technical breakdown. WTI crude technical level support levels, immediate support, $83, intraday low on March 11, psychological support level, secondary support, $80, key psychological level, 50-day moving average, strong support, $78.50, 200-day moving average, March 2026 low, resistance levels, immediate resistance, $85, previous support level, now resistance, secondary resistance, $88, 24-hour open price, 10-day moving average, strong resistance, $90, key psychological level, recent high before IEA announcement, major resistance, $92.37, intraday high on March 11, new short-term high, trend analysis, the 24-hour volatility has created a false breakout above the $90 level, with prices now back below the 10-day and 20-day moving averages. The Relative Strength Index, RSI, is currently at 42, down from 78 at the intraday high, indicating that the market has moved from overbought to neutral territory. The Moving Average Convergence Divergence, MACD, is showing a bearish crossover, suggesting that downward momentum may continue in the short term. Brent crude technical level support levels, immediate support, $86, intraday low on March 11. Psychological support, secondary support, $84, 50-day moving average, strong support, $82, 200-day moving average, March 2026 low, resistance levels, immediate resistance, $88, 24-hour open price, 10-day moving average, secondary resistance, $92, previous resistance level, strong resistance, $95. Key psychological level, major resistance, $96.82, intraday high on March 11, new short-term high, trend analysis, similar to WTI, Brent crude experienced a false breakout above $95, with prices now back below the 10-day and 20-day moving averages. The RSI is at 40, down from 76 at the intraday high, and the MACD is showing a bearish crossover. This suggests that the short-term trend has shifted from bullish to neutral bearish, with further downside possible if support levels are broken. Market sentiment and positioning. Market sentiment in the oil market has shifted dramatically over the past 24 hours, from extreme bullishness to neutral bearish. According to the latest Commitment of Traders, COT, report, released March 11, 2026, speculators held a net long position of 320,000 contracts in WTI crude as of March 10, up 15,000 contracts from the previous week. However, following the IEA announcement on March 11, we expect the next COT report, to be released March 18, to show a significant reduction in net long positions, as speculators exit their bullish trades. Hedge funds and institutional investors have also adjusted their positioning, according to data from Bloomberg. Hedge fund sold 50,000 WTI crude contracts on March 11, the largest single-day sell-off since 2022. Institutional investors, meanwhile, increased their short positions by 30,000 contracts, betting that prices will continue to fall. Retail investors, however, were slower to react, with many holding on to long positions in the hope that geopolitical tensions will escalate further. The oil market is now in a state of wait-and-see mode, with traders closely monitoring two key factors: 1. Middle East developments, whether the conflict escalates further and disrupts shipping in Hormuz, and 2. The IEA reserve release details, whether the release is implemented as planned and whether it is sufficient to offset supply disruptions. Until there is clarity on these two factors, volatility is likely to remain high. Key data releases from the past 24 hours. In addition to the geopolitical catalysts and IEA announcement, several key data releases impacted the oil market over the past 24 hours. API crude inventories, March 11, 2026, the American Petroleum Institute, API, released its weekly crude inventories report on March 11, 2026, at 20:30 Universal Time Coordinated. The report showed a surprise draw of 1.2 million barrels in U.S. crude inventories for the week ending March 7, 2026, versus expectations of a build of 1.5 million barrels. The draw was driven by an increase in U.S. crude exports, up 500,000 barrels per day to 5.2 million barrels per day, and a slight decrease in U.S. crude production, down 100,000 barrels per day to 13.2 million barrels per day. Initially, the API data provided some support to oil prices, with WTI crude rising from $88.50 to $89.20 following the release. However, the impact was short-lived, as the IEA announcement just 2 hours later completely overshadowed the inventory data. The API data is typically a precursor to the EIA crude inventories report, which is scheduled to be released on March 12, 2026, at 22:30 Universal Time Coordinated. EIA Petroleum Status Report, scheduled for March 12, 2026, the U.S. Energy Information Administration, EIA, will release its weekly petroleum status report on March 12, 2026, at 22:30 Universal Time Coordinated. Consensus expectations are for a build of 1.3 million barrels in U.S. crude inventories, following the API's surprise draw. However, given the volatility in the oil market over the past 24 hours, the EIA data may have a limited impact on prices, as traders focus more on geopolitical developments and the IEA reserve release. OPEC Monthly Oil Market Report, March 11, 2026. OPEC released its Monthly Oil Market Report, MOMR, on March 11, 2026, which maintained its forecast for global oil demand growth in 2026 at 2.2 million barrels per day, MBD. The report noted that global oil demand continues to be supported by strong economic growth in emerging markets, particularly in Asia, but warned that geopolitical tensions and supply disruptions pose significant risks to the market. OPEC also revised its non-OPEC supply growth forecast down by 100,000 barrels per day to 1.1 MBD, citing underinvestment in new supply and production disruptions in some non-OPEC countries. The MOMR had little impact on oil prices, as the market was already focused on the Middle East conflict and IEA reserve release. However, the report's confirmation of strong demand growth provides some long-term support for oil prices, even as short-term volatility remains high. Precious metals markets, past 24 hours recap, March 11 to 12, 2026, overview. Safe haven demand offset by dollar strength and profit-taking. Precious metals markets experienced a volatile 24 hours, with gold and silver initially rallying on safe haven demand amid Middle East geopolitical tensions, then falling back as the US dollar strengthened and traders locked in profits. Gold, which is often seen as a hedge against geopolitical risk and inflation, rose to an intraday high of $5,230.90 per ounce on March 11. But by 3:10 Universal Time Coordinated on March 12, it had fallen to $5,171.44 per ounce, down 0.49% over the past 24 hours. Silver, which has both safe haven and industrial demand, saw even sharper declines, falling from $89.406 per ounce to $85.42 per ounce, a 3.37% drop over 24 hours. The key drivers of the move were, 1. Middle East geopolitical tensions, bullish for precious metals, 2. US CPI data, neutral to slightly bearish, 3. US dollar strength, bearish, and, for profit-taking by traders, bearish. Gold, spot and futures. Spot gold, London Bullion Market Association, LBMA current price, $5,171.44 per ounce. 24-hour change, minus $25.26, minus 0.49%. Intraday high, a March 11, $5,230.90 per ounce, 8:30 Universal Time Coordinated. Intraday low, March 11, $5,149.22 per ounce, 17:15 Universal Time Coordinated. Open, March the 11th. 3:10 Universal Time Coordinated. $5,196.70 per ounce. Volume, 24H 28.5 million ounces, versus 5-day average of 22.3 million ounces. New York Gold Futures, COMEX current price, April 2026 contract $5,184.80 per ounce. 24-hour change, minus $57.30, minus 1.09%. Intraday high, a March 11, $5,230.90 per ounce, 8:30 Universal Time Coordinated. Intraday low, March 11, $5,155.90 per ounce, 17:20 Universal Time Coordinated. Open interest, 420,000 contracts, down 3.2% from 24 hours ago. Shanghai Gold. Shanghai Futures Exchange, SHFE current price, 1,151.48 yuan per gram, minus 0.37%. 24H intraday high, 1,153.50 yuan per gram. Intraday low, 1,143.06 yuan per gram. Silver, spot and futures. Spot silver, LBMA current price, $85.42 ounce. 24-hour change, $2.983, minus 3.37%. Intraday high, March 11, $89.406 per ounce, 8:35 Universal Time Coordinated. Intraday low, March 11, $84.45 per ounce, 17:30 Universal Time Coordinated. Open, March the 11th, 3:10 Universal Time Coordinated. $88.425 per ounce. Volume, 24H 150 million ounces, versus 5-day average of 110 million ounces. New York Silver Futures, COMEX current price, April 2026 contract $85.755 per ounce. 24-hour change, $3.837, minus 4.28%. Intraday high, March 11, $89.705 per ounce, 8:35 Universal Time Coordinated. Intraday low, March 11, $84.555 per ounce, 17:35 Universal Time Coordinated. Open interest, 280,000 contracts, down 4.5% from 24 hours ago. Shanghai Silver, SHFE current price, 21,997 yuan per kilo, minus 2.80%. 24H, intraday high, 22,020 yuan per kilo. Intraday low, 21,555 yuan per kilo. Key catalysts of the past 24 hours. The 24-hour move in precious metals was driven by 4 key catalysts, which we break down below. So Catalyst 1, Middle East geopolitical tensions, bullish for precious metals. As with oil, the escalation of the US-Iran conflict on March 11 triggered strong safe haven demand for gold and silver. Investors rushed to buy precious metals as a hedge against geopolitical risk, with gold rising to an intraday high of $5,230.90 per ounce and silver rising to $89.406 per ounce. Gold's role as a safe haven was particularly evident, as it outperformed other risk assets, such as equities and oil, during the early hours of March 11. The rally was supported by central bank buying. According to data from the World Gold Council, central banks purchased 15 tons of gold on March 11, the largest single-day purchase since January 2026. However, the safe haven rally was short-lived, as the IEA's oil reserve announcement eased market fears of a global energy crisis, reducing demand for safe haven assets. Additionally, the US dollar's rebound, discussed in Section 3, made dollar-denominated precious metals more expensive for international buyers, further pressuring prices. Catalyst 2, US. February CPI data, neutral to slightly bearish. The U.S. Labor Statistics Bureau released its February 2026 Consumer Price Index, CPI, data on March 11, 2026, at 20:30 Universal Time Coordinated. The data showed that U.S. CPI rose 0.3% month-over-month, MOM, and 2.4% year-over-year, YOY, in line with consensus expectations. Core CPI, excluding food and energy, rose 0.2% MOM and 2.5% YOY, also in line with expectations. The data indicated that U.S. inflation remained stable, but not yet at the Federal Reserve's 2% target. The CPI data had a neutral to slightly bearish impact on precious metals. On one hand, stable inflation reduced fears of stagflation, high inflation and low growth, which is typically bullish for gold. On the other hand, the data reinforced the Federal Reserve's higher-for-longer interest rate stance, which is bearish for non-yielding assets like gold and silver. Following the CPI release, gold fell from $5,190 per ounce to $5,170 per ounce, while silver fell from $86.50 per ounce to $85.50 ounce. Notably, the CPI data did not reflect the recent surge in oil prices, as the data was collected before the Middle East conflict escalated. The IEA noted in its March 11 statement that the impact of higher oil prices on U.S. inflation will likely appear in the March and April CPI data, which could lead to higher inflation expectations and renewed safe haven demand for gold. Catalyst 3, U.S. dollar strength, bearish for precious metals. The U.S. dollar index, DXY, rebounded from a low of 98.71 on March 11 to 99.234 as of 3:10 Universal Time Coordinated on March 12, up 0.29% over the past 24 hours. The dollar's strength was driven by two factors. 1. The IEA's oil reserve announcement, which eased market fears and led to a risk-on sentiment, boosting demand for the dollar, and 2. Federal Reserve commentary from New York Fed President John Williams, who indicated that the Fed may delay rate cuts if inflation remains above target, discussed in Section 3. Since gold and silver are denominated in US dollars, a stronger dollar makes them more expensive for international buyers, reducing demand. This was a key factor in the decline of precious metals prices after the intraday high. For example, a 1% increase in the DXY typically leads to a 0.8 to 1% decrease in gold prices, according to historical data. The dollar's rebound on March 11 accounted for approximately 0.3 to 0.4% of gold's 24-hour decline. Catalyst 4, profit-taking, bearish for precious metals. After gold and silver reached new short-term highs on March 11, many traders locked in profits, adding to the downward pressure on prices. Open interest in New York gold futures fell by 3.2% over the past 24 hours, indicating that traders are closing their long positions. Similarly, open interest in New York silver futures fell by 4.5%, suggesting that profit-taking is widespread. Retail investors were particularly active in profit-taking. According to data from TD Ameritrade, retail traders sold 15,000 gold futures contracts on March 11, the largest single-day sell-off by retail investors since December 2025. Institutional investors also took profits, with hedge funds selling 8,000 gold contracts and 12,000 silver contracts. Technical analysis, key levels and trends. From a technical perspective, gold and silver have pulled back from their recent highs but remain in a long-term bullish trend. Below is a detailed technical breakdown. The gold, spot, technical levels of support. Levels, immediate support, $5,150 per ounce, intraday low on March 11, psychological support, secondary support, $5,100 per ounce, 10-day moving average, strong support, $5,050 per ounce, 20-day moving average, key support level, major support, $5,000 per ounce, psychological level, 50-day moving average. Resistance levels, immediate resistance, $5,200 per ounce, 24-hour open price, psychological level, secondary resistance, $5,230.90 per ounce, intraday high on March 11, new short-term high, strong resistance, $5,250 ounce, 2025 high, key psychological level, major resistance, $5,300 per ounce, all-time high, set in 2025. Trend analysis, gold remains in a long-term bullish trend, with prices above the 50-day, 100-day, and 200-day moving averages. The RSI is currently at 55, down from 68 at the intraday high, indicating that the market has moved from overbought to neutral territory. The MACD is still in bullish territory, but the histogram is shrinking, suggesting that upward momentum is slowing. A break below $5,150 per ounce could lead to further downside toward $5,100 per ounce, while a break above $5,230.90 per ounce would reignite the bullish trend. Silver, spot, technical levels are support levels, immediate support, $84.50 per ounce, intraday low on March 11, psychological support, secondary support, $83 per ounce, 10-day moving average, strong support, $82 per ounce, 20-day moving average, major support, $80 per ounce, 50-day moving average, psychological level, resistance levels, immediate resistance, $87.00 per ounce, 24-hour. Open price, psychological level, secondary resistance, $89.406 per ounce, intraday high on March 11, new short-term high, strong resistance, $90 per ounce, key psychological level, major resistance, $92 per ounce, 2025 high, trend analysis. Silver is also in a long-term bullish trend, with prices above the 50-day, 100-day, and 200-day moving averages. The RSI is currently at 50, down from 65 at the intraday high, indicating neutral sentiment. The MACD is in bullish territory, but the histogram is shrinking, similar to gold. A break below $84.50 per ounce could lead to further downside toward $83 per ounce, while a break above $89.406 per ounce would push silver toward $90 per ounce. Gold-silver ratio. The gold-silver ratio, the number of ounces of silver needed to buy 1 ounce of gold, is currently 60.5, up from 58.7 24 hours ago. The increase in the ratio reflects the fact that silver has fallen more than gold over the past 24 hours, which is typical during periods of profit-taking and dollar strength. The long-term average gold-silver ratio is approximately 68, so the current ratio is still below average, suggesting that silver is relatively undervalued compared to gold. If the ratio continues to rise toward the long-term average, it could present a buying opportunity for silver. Key data releases from the past 24 hours. In addition to the US CPI data, several other key data releases impacted the precious metals market over the past 24 hours. US real estate data, March 11, 2026, the US Census Bureau released its February 2026 housing starts and building permits data on March 11, 2026, at 13:30 Universal Time Coordinated. Housing starts rose 0.5% MOM to a seasonally adjusted annual rate of 1.45 million units, slightly above expectations of 1.44 million units. Building permits rose 0.3% MOM to 1.48 million units, in line with expectations. The data indicated that the U.S. housing market remained stable, which is slightly bearish for gold, as it reduces fears of an economic slowdown and increases demand for risk assets. U.S. industrial production, March 11, 2026, the Federal Reserve released its February 2026 industrial production data on March 11, 2026, at 14:15 Universal Time Coordinated. Industrial production rose 0.2% MOM, below expectations of 0.3% MOM. Manufacturing production rose 0.1% MOM, also below expectations. The data indicated that U.S. industrial activity is growing at a slow pace, which is slightly bullish for gold, as it increases fears of an economic slowdown and boosts safe haven demand. Shanghai Gold Silver, March 12, 2026, the Shanghai Futures Exchange, SHFE, will release its daily data for gold and silver on March 12, 2026, at 15:10 Universal Time Coordinated. The previous day's data, March 11, showed a decrease of 24 ounces in gold and a decrease of 7,319 ounces in silver. A decrease in typically indicates that demand for physical gold and silver is strong, as traders are withdrawing metal from warehouses to meet demand. If the March 12 data shows a similar decrease, it could provide support to precious metals prices. Currency markets, past 24 hours recap, March 11 to 12, 2026, overview. Dollar rebounds on IEA news and Fed commentary. The past 24 hours were marked by a rebound in the US dollar, which reversed earlier losses amid the IEA's oil reserve announcement and hawkish commentary from Federal Reserve officials. The US dollar index, DXY, which tracks the dollar against a basket of 6 major currencies, rose from a low of 98.71 on March 11 to 99.234 as of 3:10 Universal Time Coordinated on March 12, up 0.29% over the past 24 hours. The dollar's strength was most evident against the euro and yen, while it remained relatively stable against the pound and Australian dollar. Key drivers of the dollar's move were, 1. The IEA's oil reserve announcement, which eased market fears and boosted risk sentiment. 2. Hawkish Fed commentary, which reinforced the higher-for-longer interest rate stance. And 3. BOJ rate hike expectations, which weakened the yen against the dollar. Real-time data deep dive, as of 3:10 Universal Time Coordinated, March 12, 2026, 3.2.1 US dollar index, DXY, current level, 99.234, 24-hour change, plus 0.291, plus 0.29%, intraday high, March 11th 99.31, 22:15 Universal Time Coordinated, intraday low, March 11th 98.71, 8:45 Universal Time Coordinated, open, March the 11th, 3:10 Universal Time Coordinated 98.943, volume, 24H 2.3 trillion US dollars, versus 5-day average of 1.9 trillion US dollars, major currency pairs US dollar to Japanese yen, US dollar versus Japanese yen, current rate, 158.83, 24-hour change, plus 0.79, plus 0.4999%, intraday high, March 11th 158.86. 3:10 Universal Time Coordinated, intraday. Low, March 11th 157.8 for 9:30 Universal Time Coordinated, open, March the 11th, 3:10 Universal Time Coordinated 158.04, Euro to US dollar, Euro versus US dollar, current rate, 1.1571, 24-hour change, minus 0.0036, minus 0.31%, intraday high, March 11th 1.1607, 8:40 Universal Time Coordinated, intraday low, March 11th 1.1558, 22:20 Universal Time Coordinated, open, March the 11th, 3:10 Universal Time Coordinated 1.1597, pound sterling to US dollar, British pound versus US dollar, current rate, 1.3412, 24-hour change, minus 0.0003, minus 0.02%. Thank you for watching today's Market Meridian Financial Report. Please give me a big thumb and subscribe my channel. Disclaimer: this Market Meridian Journal report is for informational and educational purposes only. This report is not intended to constitute financial advice, investment recommendations, or trading instructions for any asset class, including crude oil, precious metals, currencies, equities, or commodities. Investors and traders should exercise independent judgment and consult with a qualified financial advisor before making any investment decisions based on the content of this report. Market Meridian and its affiliates shall not be liable for any losses, damages, or expenses incurred by any party as a result of relying on the information contained in this report, including but not limited to direct, indirect, or consequential losses arising from market volatility, trading decisions, or geopolitical developments.